All right, guys, so this is a really important episode. What we're going to take a look at is diagonal levels of support and resistance. These levels of support and resistance help us identify what trend we are in within the markets of whatever asset that we're looking at. And you may have heard this before, but in the markets, the rule of thumb is a trend is your friend. So you need to take your time with this episode, because if you're trading with the trend, you're going to have a better chance of success and profitability. Without further ado, let's get into the episode. I hope you guys enjoy it. Yes, guys, welcome back. So we're building the blocks of technical analysis. Things should be getting exciting. I hope you've gone off into your charts and had a little play around and stuff like that so far. Just with the key concept you've learned already, you can really map some powerful projections. All right, but there's so much more to go. There's so much more to learn. And we're going to get into it now. So we've spoke about single candlestick formations, double bar formations, triple bar formations, and horizontal support and resistance. Now we're going to talk about diagonal support and resistance, or what is also known as trend lines, okay? So let's just go back to the basics again, and I'm always going to repeat myself and reiterate concepts, so it just gets embedded as we go along this journey, because it's really important, and repetition's key. Just always hearing me repeat things will be so much more beneficial for you guys anyway. As you know, we analyze time, which is along the bottom, and price, which is along the side, and the candlesticks print the flow of supply and demand of the asset that we're analyzing. So right now we're actually looking at Ethereum, all right? And obviously as time goes on and price prints, it flows like that and it prints like, isn't like that, but you know what I mean. It flows like that and it prints like that. What we are now about to go and talk about is trends, okay? And trends are essentially what happens when either the demand of an asset continuously outweighs the supply, or when the supply of an asset continuously outweighs demand. If the demand constantly increases, the price of an asset is going to go up. And then that's true for the flip side of an asset as well. And like we've spoken about, okay, the markets are driven by human psychology. They're driven by the perception. They're driven by the market participants' perception of the price. Okay, so with that, we know how predictable and how humans can quite often repeat their nature, especially in heightened emotion situations. And the financial markets are one of them situations where emotions get heightened. All right, so humans that are driving the markets, they repeat the same behavior patterns, okay? So every now and again, which is what we're gonna go through, and this is what you're learning, all right, you get to see certain patterns that may repeat, and you get to see structure and repetition and rhythm within the markets. So, like I've said, the markets do sometimes tend to trend. That's when the flow of supply and demand is outweighed to one side over a given time period. So you'll see a trend. You'll see the market go up or down continuously for a given period of time. So you get trends, all right? And also remember the concept of the fact that the markets are driven by human psychology and human nature. So you do sometimes get some sort of repetition and some sort of rhythm. And with that, you get really nice trends. And within these trends, you can be really accurate with the direction of the market, because obviously you're in a trending market. That's the whole idea. And you'll hear all the time, the old adage is a trend is your friend. And we will always advise to look for positions within that align with the trend. So this lesson is really important. And I'm going to show you how it sort of prints. So like we say, time is along the bottom, price is along the side. As the market goes higher, say for example, we're in a bullish trend, what would happen is price increases. The demand of an asset has increased. For some reason, you know, say this is like the birth of Ethereum. Price prints, people buy, the price goes up, all right? And then obviously people take profits or whatever it may be, the price goes down. And then there's more interest, there's more demand, and the price goes up. And then it settles down again, people take profits, and so on and so forth. And this pattern just repeats itself. Okay, over and over and over again. It can't happen forever. Can't go in one direction forever and ever and ever and ever and ever and ever and ever. Well, in a way it can, but what I mean by that is it can't just go up forever. There has to be some sort of retracement or some sort of correction, because that's the flow of supply and demand. But when you look at things like the S&P and all these other sort of asset classes, you do see the market does continuously go up, but there has to be these downward movements within there, and that is the healthy flow of supply and demand. All right, you need that, because if an asset just went up and up and up and up and up, then the price is just going to become unattractive. People can't afford it, or people won't see the value in it because they're like, no, that's too expensive, or people just simply can't attain it. If an asset goes down for too long, people are going, well, I don't want to buy that. The price is going down. Where's going to be my return in investment? All right. That's the concept. So you get this healthy flow where the demand goes up, people will take profits, or there may be a counter catalyst for the demand to go down. And then maybe some people may come back in and buy it again. And remember the support and resistance lesson. What you're getting here is you're getting resistance being formed by the supply, by the demand being taken out and the supply being increased. And then you get demand being formed by the interest. And then you get the demand taken out and the supply decreased. Same again. And it's this simple flow. And then what you get is your support and resistance. But diagonally, you get yourself this. Boom. Sorry, I could do that way better. You get this. And what this is a trend line. Okay. It's a trend line, like you can see, very beautifully placed. And you know what? Sometimes you will get trend lines that are literally this accurate. I need you guys right at the very beginning to understand what a trend line is. Okay. There's so many lessons out there, and there's so many courses and education out there that will talk about trend lines like they're magical levels that you can trade to and from. They're not really. They can be added together with other really powerful concepts and powerful ideas and powerful patterns to increase the probable outcome of a trade. Because what you'll see is, if a trend line's being respected once and twice, the likelihood is it may be respected again for a third time. But anyway, we'll get into all of that at a later date. For now, I want you guys to understand what this is and why this prints. So essentially why this prints is because you constantly have demand outweighing supply and the price of an asset goes up. There's continuous interest. There's demand there. So what you have is a trend. The market is trending, and the market is trending, in this case, bullish. Yeah? That's what's happening within this market. Okay? Sometimes what you'll get is the market will go up, and it'll go up, and it'll go up. And then eventually there has to be a change. Something may happen and the market may begin to flip, and it may begin to trade lower. In this case, what you may sometimes see though, and you will always see this in fact, is the market will sometimes trade higher and there will be an increase in demand, and then boom, some sort of catalyst may change that sentiment, okay? And you may begin to trade lower to the downside. This would then be a bearish trend, and you could have a trend line plotted on the chart like that, which will show you clearly that the supply is outweighing the demand and the demand isn't strong enough, and right now the market is trading lower. And what you would see here would be the resistance being formed. You'd have your support and resistance being formed, and it's breaking and flipping, and there's a continuation of a decreased price of that given asset. The idea is, okay, if the demand comes to a certain price point and then it breaks and then it can't exceed it, eventually it will do. And when it does, it usually comes back to find this previous price point, which is why we can trust support and resistance. And then that continues, all right? Yeah, which is why then you get these trend lines being formed. It's the psychological flow of the markets. It's what happens. It's the way it is. It's been the way it is throughout technical analysis from the beginning. That's why this has become a mean and a tool for us traders and investors to use in order to dictate the directional bias of an asset. Because thankfully, we are trading human psychology and human nature, and with all that, we're trading predictable people. So now let's go to the charts and have a little look and identify some trends. So with trend lines, okay, and we're going to go into this in much more detail. I'm not going to overcomplicate this early lesson because it's a part of later episodes where we go in and we start to chop things up properly, okay? But as as a asset develops its price, you get trends within trends and counter trends, and all these different things happen as a price of an asset develops. And you have larger trends over time and smaller trends over time. I'm going to go into that in more detail later on, but I'm just going to show you guys how to identify some trends and how to plot them so you can go away and play around with it. This is not going to go too intense at the beginning of the early stages of this educational series, so don't worry. So let's look at the daily time frame. What we can see on the daily time frame here on Ethereum of recent time, we've had a nice little bullish trend, and it's quite clear, right? We had this low being formed, which is support, and then from there we've actually been trending higher. So there's a little trend line. Okay, what will confirm a trend line is 2 points, just like support and resistance and like a double bottom or whatever. You've got your point A, you've got point B. Okay, what we can see here is the market is trading above this trend line and it's continuously printing higher highs and higher lows. And we have a bullish trend. Going back a second, what I mean by higher highs and higher lows is this, okay? The market will print, it will retrace, it will print higher, it will retrace, it will print higher again, and then it will retrace. What I mean by higher highs, in a bullish trending market, this would be regarded as a higher high, and this would be regarded as a higher low. Why? Well, because this low is higher than this low. And this is a higher high in this context because it's higher than any high that's been formed just as of yet. And that flow of cycle continues. Now we have a higher high than the last one, and a higher low than this low, and a higher high and a higher low than this one. Okay, so it's that flow, that's that trend being formed. So what you have is higher high has been formed on this side, higher low has been formed at the bottom, so you have a bullish trend. The exact same is true on the bearish side. When you start to print lower like this, and you're forming them breaks of structure, and you're forming the lower lows and the lower highs, and you're forming that support and resistance to the downside, what you're forming is a lower low, a lower high, a lower low, a lower high, and that continues. So when you hear me say lower lows and lower highs and higher highs and higher lows, that's what that means. It's essentially the low being lower than the other lower low, and the lower high being lower than the other lower high. It's just that flow that goes down and down and down and down and down. So going back to this example, we have this nice trend going up, and we have, this would be regarded as a higher high, really. So we have a higher high. This could be regarded as a higher low. This could be regarded as a higher high. And maybe we will call this the higher low. That's a higher high. And then that would be the higher low. One thing that is very, very true as well, and remember, is based off the horizontal level of the horizontal support and resistance level. We like to look for really key swing points in the market, and what we would regard as a key swing point is where the market has reacted very significantly to it. All right, and like you can see, these are quite significant, these swings, because you've seen quite harsh reactions from them. What I mean by harsh reactions is the fact that look at what happens when prices came off these points. You've had huge moves, big sell-offs, huge moves. Here's another one. Say this, well, both of these really. Huge moves, big sell-offs. And it's like a staircase. It's like if you were a human, you could walk up these stairs. Do you know what I mean? So it's like you've got this continuation, and then it's the move in price to one side, which is to the right, and the gain in price going up, and that just creates this nice flow. And when you're in a trending market, you do get these really nice patterns which we're able to anticipate and trade from as traders. And the beautiful thing is when you start to tie things together and you have things like resistance, which flips to support, we can then look and get in around here for opportunities because we know that we're in a bullish trend. But again, let's save that for later. Now we're over to Bitcoin. Here's a really nice little bullish trend line. Look how beautiful this one is. Boom. So we've got, look how accurate that is, by the way. So we've taken it from this little low here, okay? And you've had one test, two tests. Look how accurate this is. You've got your point A, you've got a secondary test, and the third test is so accurate. Let's even pull it a little bit more accurate. But you can just see how accurate that is. When we go to the daily time frame as well, you can see how significant these moves were off here. Now we've gone all the way back. Look at this. This is a bearish trend because we have this constant printing of, this is a lower low. No, this is a lower high, sorry. Lower low, lower high, lower low, lower high. And then this isn't actually considered a lower low because it didn't go lower than this point. But this one is a lower low and that's a lower high. Like you can see, it's like, the way I like to picture it, it's almost like if you were to drop a ball downstairs, it would go boing, 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 and it would bounce down, wouldn't it? It would bounce lower. On the bearish side, that's a good little analogy for it. Imagine if you had a ball here and you were to throw it, it would just boing, 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 boing. You know what direction the ball's going in. It's going down. Similar sort of concept. Then just imagine it on the flip side for the upside almost. Again, here's a nice little bearish trend. You have your point A and then you have here, or you could even pull it to here. Sorry. Here's a really nice example actually, because you have this huge sell-off, which is a significant sell-off, right? So that alone tells us, okay, now this is there's a lot of sellers in the market. There can't be much demand compared to the, here's a really great example, okay? Because you have a huge sell-off, which is a significant swing point. And then look, the market comes back up and it trades into here, sells up again, comes up, trades into here, sells up again. So you have your lower, and look, it's within an overall bearish market as well anyway. Because look, if we pull this trend from here to here, we're already trending lower. I'm not going to overcomplicate this and get this too messy because we're going to go into this in much more detail at a later date. But you understand the concept. By pulling these trends from one significant swing point to the other, you can begin to see the direction the market's going in overall. So we don't go into too much crazy stuff this lesson. I'm going to leave it here. Go off in the charts, go onto all your favorite crypto assets and go and try and identify some trends. Trend line tools here, just go and drop them on. And you can be really loose with these as well, you know, like you don't actually like, sometimes I'll just plot them on just to be like, just to help me. Like, yeah, right, okay, we're bullish. And you could even go further back and you can even pull it like from this significant swing point to this one. Like, that's like essentially a bullish trend. Next episode, we're going to go into things a little bit deeper. Thanks for watching and I'll see you in the next episode. All right, guys, so I hope you're enjoying this so far. These 2 episodes on support and resistance, diagonal and horizontal, are so important in your journeys. You need to take your time with this. It does not matter how long it takes. But I hope you're enjoying the journey so far and I will see you in the next episode.